Level 1. The bag holder. You have $6,000 in your account, 8 months of savings. The moment you tap buy on Robinhood, the app erupts in confetti. Tesla, 32 shares, average cost $187.40. You have no idea you just walked into a multi-trillion-dollar ecosystem built on algorithms, privileged information, and professional short sellers. All you know is someone on Reddit's r/Wall Street Bets said this one was a sure thing. At this level, every day looks the same. You watch pre-market news. You follow CNBC anchors who explain what the market might do today. You buy on hype. You sell on fear. You buy high and sell low. Not because you're stupid, but because retail investors receive information at least 18 to 72 hours after institutions already acted on it. You hold Tesla for 43 days. The stock crashes twice. Both times, you tell yourself to wait it out. You finally sell at $141. Loss, $1,484.80. You tell yourself it was bad luck. Next time will be different. Your account has $4,515.20 left. You open YouTube and type, "How to make money in the stock market." You don't realize yet, you just paid the entry fee. Level 2. The chart guy. You spend 6 months learning technical analysis. Here's what that actually means. Bollinger Bands are built from a 20-day moving average plus or minus 2 standard deviations, measuring price volatility. RSI above 70 signals overbought, below 30 oversold. MACD is the gap between a 12-day and 26-day EMA, with a 9-day signal line on top. You start drawing charts. You mark support and resistance levels on TradingView. You believe price will bounce at the right spot. You buy a $497 online course from a guy with a pool in his backyard who tells the camera this system wins 73% of the time. At this level, you live inside a language made of shapes and lines. You believe past price action predicts the future. There's some truth to that. Collective behavior does leave recognizable patterns, but there's a structural problem no one wants to say out loud. The moment enough people recognize and trade the same pattern, the market digests it. The edge disappears. You win a few times. Your account climbs from $4,500 to $7,200. Then you go heavy long on a Chinese ADR because the chart shows a completed inverse head and shoulders. 2 days later, the stock drops 31% pre-market. The SEC just announced an accounting investigation. The charts had nothing to say about it. You lose $2,300 and 3 months of confidence. You start searching. Why does technical analysis stop working? Level 3. The professional trader. You pass the written exam and simulated trading eval at a proprietary trading firm in Chicago. They lease 2 full floors on South LaSalle Street. Day 1. You sign a non-compete and a risk disclosure, 74 pages combined. They fund you with $50,000 with hard rules. No more than $1,500 in losses in a single day. No more than $5,000 total drawdown, or your access is cut immediately. Nobody here watches CNBC. They watch Level 2 Quotes, a live feed of NASDAQ market maker bids and asks, showing where orders are stacking up, who's actively hitting the market, where the money is moving. They also track dark pool prints, large institutional trades executed off-exchange, reported publicly with about a 90-second delay. That 90 seconds is your window. Your cut is 30%. A solid month, the book makes $18,000. You take home $5,400. A bad month, you take home nothing. The firm absorbs no losses on your behalf. The one thing this job teaches you, emotions are the most expensive thing in the room. Every time you deviate from the plan because something feels right, it shows up in your trade log. Your desk manager reviews the week with you on Friday. He doesn't ask how much you made. He asks whether you followed the rules. Your social life quietly disappears. You're in at 6:30 a.m., staring at screens until 4 p.m., reviewing until 6, then home to sleep, then back. That's called discipline. At this level, it's the only thing keeping you alive. Level 4. The Hedge Fund Analyst. There's a new LinkedIn message waiting for you. It's from a recruiter at Bridgewater Associates, Greenwich, Connecticut. Bridgewater manages roughly $124 billion in client assets, pension funds, sovereign wealth funds, university endowments. There's no day trading here. The work is macro strategy, building long/short positions across asset classes using global monetary policy, rate cycles, and geopolitical risk as your raw materials. Your job is to write memos. Each memo gets rated by colleagues and senior staff through an internal system called the believability-weighted framework. Your track record of being right determines how much your opinion counts in any given decision. Tenure means nothing. Accuracy means everything. People at this level use Bloomberg terminals, $24,000 a year. They track every word change in FOMC meeting minutes because a single adjective swap can signal a pivot in rate trajectory, and a rate pivot can ripple through $200 trillion in fixed income markets worldwide. But there's a new dimension opening up. You start attending the Aspen Institute's annual conference. You meet former Treasury officials. 48 hours before a policy gets announced publicly, someone, in a private conversation over drinks, tells you which direction it's headed. This isn't called insider information, it's called an expert network. Compliance will tell you where the line is. The line is blurry. The colleague who sat at your desk 3 years ago now works at the SEC. You're beginning to understand, in this market, information is power, and access to information depends entirely on who you know. Level 5. The Market Maker. Your title is Chief Market Making Strategist at Citadel Securities. Base salary, $850,000. With performance bonuses, last year you took home $2.3 million. In 2023, Citadel Securities handled roughly 28% of all U.S. retail stock volume. None of it goes through exchanges. The mechanism is called Payment for Order Flow, PFOF. Retail brokers like Robinhood and TD Ameritrade sell their customers' orders to Citadel, which fills them internally and pockets the spread. Your job is to make that machine run faster. Your team has 47 quant engineers. The algorithms process millions of trades per second, measured in microseconds. Your servers in New Jersey sit physically closer to the NYSE's matching engine than your competitors do. It's called co-location. The speed advantage is 0.3 milliseconds. In high-frequency trading, 0.3 milliseconds is the difference between hundreds of thousands of dollars in profit and a missed trade. People at this level don't debate whether a stock will go up or down. They talk about liquidity, spreads, and market microstructure. They know exactly what retail order flow means because they own the data. You've testified before Congress twice. Senators asked whether PFOF harms retail investors. Your legal team prepared a 40-page statement. You answered every question calmly, precisely, in language that couldn't be used against you. Nothing was admitted. Nothing changed. You have 3 sitting U.S. senators saved in your phone. That's not corruption. That's called policy engagement. Your kid goes to private school in Manhattan, $62,000 a year. Your spouse hasn't talked to you about anything other than markets in 3 months. Level 6. The Rule Writer. You no longer appear on any public list. You're listed as an advisor to a family office registered in the Cayman Islands. Your name isn't on the website. You oversee roughly $4 billion in assets. You have 7 clients. Every single one was introduced through a private referral. You don't predict the market anymore. You participate in writing the rules it runs on. Over the past decade, you've funded 3 academic economists who published Fed working papers on market structure reform. Those papers became the theoretical foundation for 2 SEC regulatory amendments. The amendments happened to reduce compliance costs for high-frequency market makers. That's not a bribe. It's called building the intellectual infrastructure. You have a standing seat at an informal dinner that runs alongside the Jackson Hole Central Banking Conference in Wyoming. The dinner isn't announced, isn't documented, and sends no invitations. The fact that you're there is itself the credential. At this level, you don't execute trades. You shape conditions. You decide which kinds of capital can flow into which kinds of assets. You engineer rules that give certain players structural advantages. You set changes in motion that will reshape the entire market 5 years from now. The transformation happened so slowly that you can't identify the exact day it began. You haven't felt excitement about a single trade in years, not because you're numb, but because the word trade has become too small, too specific. It's the way an architect looks at a floor tile. The last time you felt genuinely alone was after a conference call ended. 11 people dropped off one by one. The line went silent, and it was just you. In that moment, you understood. No one in that room was your friend. No one was your enemy either. Every person was a function, including you. Your name won't appear in any historical record, but 20 years from now, an economist studying this era of market structure will write a footnote, deliberately vague, about a structural influence emanating from private capital. That footnote is about you. This is the price of the highest level. You no longer exist in anyone's story, not even your own. Somewhere, a 23-year-old just deposited his first $6,000 into Robinhood. He's staring at Tesla's candlestick chart, convinced he's seeing something. He isn't. But he'll spend the next 20 years slowly learning what that sentence means. And by the time he understands it, he won't tell anyone. Because up at that level, no one's listening anyway.